right now. Now, neutral might be another 50%, a 50 basis point cut. Who knows? But the real key point is the Fed put is more or less alive and well and back again. Whether or not they want it to be, it sort of is. And that kind of matters. Now, as far as Bitcoin and crypto is concerned, I think that, and other macro bits, first of all, it's worth mentioning that the yen is back down to levels below which caused the freak out on August 5th. And obviously, the fact that Nikkei is only down 4%, Bitcoin only retraced, some of its gains, it's still up on the week, on the 7-day from the last time we talked. So, whatever, is actually quite interesting. It means that people got their hedges in order and didn't kill themselves, by being overextended on the yen. Again, at 142, it went from pushing 160 down to 145, and now today it's at 142 and change. So that matters, right? The other thing to look at is across crypto. What we see today and this weekend looks like a very typical rotation over the last week that you normally see when Bitcoin has an up leg. It then moderates for a bit and altcoins move higher. The fact that Solana, they're the marginal people who do price formation, but the bid is coming from spot, and the bid is coming from ETF buyers and central bank buyers that we don't hear about, and sovereign wealth buyers. And those buyers are, to the extent they can get away with it, are very, very patient. And so far they've been able to get away with it, and they will, hopefully for them, will be able to get away with it for quite some time. What I mean by get away with it is, as long as big buyers don't spark FOMO in the market, they can afford to be patient, and they have been through this. So we've seen a pretty large rotation. Over 15 billion into ETF holders from
it was 1.2 billion last week. 1.2 billion into the Bitcoin ETFs last week, and quietly, BlackRock Spot Ethereum ETF here has surpassed $1 billion, making it one of the top 20 ever. I mean, they're terrible, but they're doing well, right? So
it's a rotation, and we understand rotations and accumulations don't happen at tops, right? And that's all I'll say. And I'll mute myself again because I'm in a hotel lobby. For those who care,
you're doing good. You're doing good.
So let's pull back. Back to scenario.
But they preempted that with 50 bips. So, right, I mean, it goes back to the same question of, do they know something we don't know, or are they trying to get ahead of it? I mean,
well, but remember, Scott, we didn't have a meeting in August, so it kind of gave them cover, and that terrible beige book number, or that terrible beige book reading. They're not really numbers; they're readings. Was enough cover to say, yeah, if we had this is basically telling you that if we had a meeting last month, we would have cut 25 basis points. We're adding another 25 basis points here to make it 50. It's not a panic cut. It's just we're catching up a little bit. And the second, well, go ahead, Mike, because you came off mute, and I think you're going to respond to that, and I can add to that.
Well, I just want to add one thing. I think the thing that's different this time is, what's the same, first of all, is we all know.
You said different this time.
Well, I'll say what's different is that how expensive the U.S. stock market is at the start of an easing cycle as the Fed sees deteriorating economic growth. Not just the Fed, every central bank on the planet, with the exception of the Bank of Japan, and most notably the second largest economy, which has been in a deflationary spiral for almost 2 years now. That's China. The bottom line is those equities are so expensive now. I mean, I can measure 18 measures. I'd rather just stick with one that is,
very specific. That was formed by a massive imbalance and huge risk taking in residential real estate, and it was trillions of dollars. And for those who weren't in it, and for people here, unless you were involved in the market in the credit markets, and I mean involved, you don't know how bad it was. And it was very, and people don't talk about it. You don't get it. But I have friends who are hedge fund managers that traded emerging market debt, and they went from things, bonds trading, whatever. Let's say a bond, their portfolio would turn over, or they would have calls or whatever. 100 trades a week. It went to one trade for 3 months. I mean, it was just no bid for enormous numbers of instruments, and the entire market seized up. And James could talk about this at length, but that is very, very different.
reason for that is that we are so financialized, so leveraged across the entire world that this matters more than anything else. How much liquidity is in the system? Is it being added or is it being taken out? Because we cannot keep growing unless we add more debt. That's just reality right now. And so that's why these guys are focusing in on it. Another thing, we were talking about before is trying to figure out where the Fed is going, which is part of this, is how much are they going to cut rates? Well, if you look back at the Fed dot plot, and Mike can pull this up on his Bloomberg terminal. If you look back last meeting, the cuts were being estimated by the Fed officials to, and I'll stop sharing this, but they're estimated to go down under 3%. But now that terminal rate looks like it's going to be 3%, which means that the Fed officials believe that that terminal or that neutral rate is around 3%, and we're going to try to get there as fast as possible. And so that's what
to is forward-looking. What you mentioned, James, earlier about Nikkei. If you overlay that Nikkei with Bitcoin for the last couple of years, it's almost tick for tick, and it's just signs of liquidity, and signs of what usually happens is when you get risk assets too expensive, they go down. So here's my base case remains is, when you get to this stage in the cycle, we've all known the macro, we've all seen it before. If all entities in the planet start adding liquidity. But one thing that hasn't happened in any of our lifetimes, and we only have history to go back to, is how relatively expensive assets are in the U.S. Starting with the U.S. stock market, it's the most expensive even versus a housing market, which is most expensive ever versus income. In that kind of environment, you can only keep that elevated for so long. You always get some reversion. It's just a question of when. And that's why I like to point out, that's why I'm sticking with gold and long bonds.
Hey, I'm taking a look right now. Where is it? There's an article here. FOMO grips China stock buyers on epic trading day before break, right? This is kind of what you're talking about. Obviously, Hang Seng is
it was
Hong Kong, but back in a bull market. Chinese CSI 300 index enters bull market.
But I think that, Mike, you're long all of that. I did live through the 70s. We had our gas lines where I couldn't go to hockey because we couldn't fill up our car that week. Like, we literally were not allowed to.
It was a big
we
deal.
didn't have a voucher. Yeah. We were on an odd week. It was mental. Okay, so I remember all that. However,
well, in Chicago, we skated to hockey.
I wish I had dreams of that. We didn't have rivers where I was. Yeah, the Mohawk didn't freeze over in northern New York. But
we rode our sleds.
The other difference is that back in the 70s, our debt to GDP was 30%. It's now over 120. Like the difference is that whether or not we've even learned our lesson, it doesn't matter whether we've learned our lesson or not. We're backed into a corner of liquidity needs. Like, we just have to have it, or else you'll have, like, just think about us going into recession. Just think about the numbers of going into recession. We're already at a $2 trillion
of the Fed actively buying bonds. People used to say, if the government was buying the stock market or buying bonds, they used to make fun of the so-called plunge protection team, right? People used to say if they did that, the markets would go into some sort of hyperinflationary, nonsensical collapse. And the reality is people just accepted it because they accept what the manipulators are doing. And until that house of cards falls, and hopefully that will be a couple generations from now, but at least after I'm dead and buried, we'll worry about it. But that's the biggest difference between the 70s and now, is the 70s was the start of the fiat experiment. And that's why debt to GDP is where it is. We've been untethered. And those of us that are Bitcoiners and those of us who are gold bugs, and it's the same, say, you know what? Gold in 1971 was basically 90+% of monetary aggregates in value. And then they, or at least that was the idea. And then, of course, the price of it's had a very good week. It's now bumping up against its intermediate, high. And there are a lot of people talking about it. Now, I will continue to say, and I would love to get educated on this, that I don't understand how an asset that is so materially owned by one company has sufficient scarcity as to justify, even if it's adopted as the method of all global payments. I don't see why, what that does to the asset, but I could easily be wrong. And I freely admit it. I need to be educated on what the supply demand dynamics are there. But that matters, because if we end up with a Main Street asset that's being used in the world of crypto that's not a central bank digital currency, it might actually matter as well. And so we tend to ignore it because it has had so much less volatility, being stuck in this, basically around 50 cents for so long throughout all these rallies. But if that starts to break,
when I was in Hong Kong talking about it, there's enough. That's an unstoppable trend. I completely agree. The technology is overwhelming, but I remember saying there was Bitcoin, then there's 10,000 wannabes, and then there was 20,000 wannabes. Now there's a million wannabes. I mean, we're going to look back at this from the future. Say, yeah, it's massive speculation, just like the railroad rally in the 1800s and the .com peak to 2000. Then the dust settles and things come out of it, and that's where right now the problem I like point out is when people point out to, yes, I get the Bitcoin thing. There's certain times, and we all like Bitcoin and gold, but there's certain times I think it's better to be overweight gold than Bitcoin, particularly when volatility is in the stock market's at basically almost a 10-year low and potentially going higher, and Bitcoin is just so volatile. At some point, I think it's going to do what Saifedean Ammonimus predicted. Well, maybe central banks will buy it, but at 3 times the volatility of beta and gold, I'll stick with gold, particularly when I think volatility in the stock market's going up. And the bottom line, it's gold so low.
But and because gold has demonstrated it's a strong store of value over thousands of years,
is Bitcoin options, options on IBIT being approved,
right?
And who knows when we're going to get the single day options on IBIT? But it's like the volatility in the gambling culture that could come in the United States could be interesting. I mean, the long term effect of that generally is to decrease volatility. I'm not sure that will be the case in this event.
I think the long term of it as well is even for me. I mean, I'm welcoming it because it makes it easier for me to hedge a book and have and hedge volatility with options as an institutional investor in my hedge fund. It's just so much easier to do that. You can't do it all hours, but it's going to be very liquid. It's going to be very important for traditional institutions. I can go do it elsewhere. I can have accounts elsewhere that I can trade options on Bitcoin without having to do it on the New York Stock Exchange or SIBO, whatever. But this is going to hedge their book on a Delta hedge, and with an asset like Bitcoin that is highly volatile in the short term, that can produce something called the gamma squeeze that you know all too well, Mike. That
you said short term,
it can produce some volatility that is explosive to the upside.
It's so the bigger one. I just want to point out the bigger one because that's true, but that's no different than the liquidation cycles we see in perpetual swaps. It really isn't all that different. So what is different is the dominant use case for Bitcoin in the next cycle. What will end this upcycle? And here's the prediction. I'm giving a 4-year prediction, right? What will end this upcycle is people, when the upcycle starts to end, you will see an entire huge number of people selling covered calls in order to generate yield, which will, as it always does, work until it doesn't. It stops working if it rallies past it. And all of a sudden, people who think they're long Bitcoin aren't anymore. And that creates a far bigger squeeze when you have funds that are supposed to be allocated to Bitcoin that have sold, that effectively it's gotten taken off because it's rallied.
260-day volatility Bitcoin was about 10 times gold. Now it's about 3 times gold. It's going to go to 2 and potentially 1. But if volatility in the stock market continues to increase, it should underperform, and it's been doing that for, yes, you're cherry picking, I'm cherry picking, but it was only a few months. It was only about a month ago volatility in the stock market maybe bottomed.
It was a joke, by the way. That's hilarious. I'm also, I thought Scott was paid to slam soul meme coins. Yes, unless you watch certain people who say I was promoting soul meme coins. Hey, man, you can't do this out here. Listen, we had the title. Bitcoin enters October. Will it make to new all-time high? I know that we're here. It's 10 a.m. I just want to go around the panel. Quick take. I think we make a new all-time high in the next quarter. I don't know about October, but I think that we will make a new all-time high in this quarter. Dave, do you think so? Yes or no?
Yes.
Bitcoin. James?
I do.
Mike?
Gotta have a contrarian, no. So I'll be the contrarian. Come on, it's more fun. If beta goes up, maybe mine. But
it's like ESPN Game Day. You can't have all the same teams at the bottom.
We're worthless. If we all agree, then we only need one, right?